Art Collins with you. Want to take a look with you today at a rather unusual relationship between the S&P futures and the T-bond market. First of all, you got to get your setup right. Create a 5-minute S&P chart, day sessions only, 8:15 a.m. through 3:15 p.m. Central Time, and you want to insert 30-year bonds using that same time frame. That's not the official time frame of the bond market, but make it fit the S&Ps anyway. Customize your chart so that it's 8:30 through 3:15 p.m. also. Now, if you're not on TradeStation, or even if you're not on any trading platform at all, don't sweat it. You can just look at the two markets, and you'll see the signals. They're not complicated, just by eyeballing them. So the deal is, you're looking at two bars in a row that have higher open to closes. But that should be the case in both markets. The S&P and the bond market both have higher open to closes, two bars in a row. Now, I know what you're thinking. You've seen plenty of examples of where the S&Ps and bonds move inversely. We're seeing a very, very radical version of that as I speak. The bond market went up over 7 points. That's just about unprecedented. I think it is unprecedented for the nearby month. Went up over 7 points at the same time that the S&Ps were continuing their coronavirus melt. But we're just talking 10-minute sprints here, okay? And performance summaries will show that that's a different animal entirely. All right, so between 8:45 and noon, going to get you all out to the golf course or whatever you like to do early. Buy if the last two 5-minute bars in a row closed higher than they opened in both the S&Ps and T-bonds, and sell short if the opposite is true. 2 bars in a row, lower open to closes in both the S&Ps and T-bonds. Use a $400 money management stop. If you get an opposite signal, you take that, flip your position around, and any trade that exists, you get out at 3:15 p.m. I lied a little bit about when you can get to the golf course, but since you can't enter after 12 o'clock, wouldn't be much after that, right? Anyway, here's your performance. S&P market, $60,000 from the beginning of 2010 through March 5th, 2020. Worst drawdown of $9,000. Why isn't my cursor working? $31 average trade before slippage commission. That gives you a 662% return on account. And as I always remind you, that's how much your account would have increased had you started with your worst drawdown amount. All right, so kind of a nifty little S&P bond system. That is also a Dow bond system, a NASDAQ bond system, a Russell bond system, and a mid-cap bond system. Didn't have to comply this way, but it did. You get your best results in the NASDAQ. 66,000 with an 840% return on account. Drawdown less than $8,000. Such a deal. All right, so your takeaways. S&P momentum tends to be fortified by the same directional movement in the T-bond market. We're talking, again, little short sprints intraday. The S&P bond system works in all 5 major U.S. equity-related futures markets, providing robustness and a wider array of trading opportunities System has a reasonable stop loss and no overnight risk. Check this out. Finally out, beating the financial futures market. 2020 Almanac, keying off the original 2006 book. And again, I am Art Collins. Thank you for joining me.